Very good afternoon, ladies and gentlemen. Hello, I can't hear, guys. Very good afternoon, ladies and gentlemen. Yeah. Success is a result of perfection, hard work, learning from failure, loyalty, and persistence. It's a great pleasure for me to introduce such successful person and the session chairman, CA Mohan R Lavi, sir. CA Mohan R Lavi is a member of ICAI with a work experience of more than 28 years. He has worked in senior positions in finance, manufacturing, and software companies. At present, he is a partner with KP Rao & Co. Chartered Accountants, Bangalore, and heads the Ind AS and GST practices of the firm. Mohan is author of first book on service tax that was published in 1994. He has authored books on IFRS, Ind AS, the SOX Act. He is a regular contributor of articles to Hindu Business Line and Deccan Herald on accounting standards, taxation, and GST. Mohan has spoken at various conferences in India and abroad on accounting standards, IFRS, SOX, and GST. And he is a faculty member of ICAI and other professional bodies. Dear friends, let's welcome him with a big round of applause. Now, I would like to introduce student speakers. Our first student speaker, E. Ayyanna Achari. He is pursuing his articleship in KPMG. He is confident with his positive attitude and known for time management. He has secured 5th rank in pre-university. He was the winner of Best Student for the year 2013. He got Rising Star Award in KPMG within 6 months of joining the firm. Our second student speaker, Varsha Jain B. She is pursuing articles in HC Kincha & Co. Bangalore. She is very good with her interpersonal skills and known for her focus and determined execution of plans. She has secured 10th rank in pre-university. She has participated in various games like chess and secured many medals. Let's welcome both the student speakers with a big round of applause. I request Mohan sir to take over the session. Thank you.
So, good afternoon, everyone. One of the advantages of being a session chairman is you don't have to speak too much. Right? So, I'm just going to sort of give a little bit of background because I think it's only fair that the student speaker should be speaking the most in a session like this wherein they're talking about the differences and all those things. But I just want to give you a little bit of a background before they can take over. We're talking about the Ind AS versus the AS differences. This effort to converge our present accounting standards to Ind AS has been happening for quite some time in India. In fact, the International Accounting Standards Board in 2006, they were on a global tour to promote IFRS, because 2004 IFRS was implemented all across Europe. And in 2006, they thought it was fit to come to India, because they said you have got a lot of software companies, got a lot of pharma companies, exports, and you also have a lot of controversial companies. So, you should probably implement IFRS. So the Ministry of Corporate Affairs, they were looking at all the advantage which the IASB thought India has got is because we are already following, your present IAS is modeled on the International Accounting Standards, IAS. So they were saying since the IAS has become IFRS, it should not really be a problem for India to move over to IFRS. This was their thinking. So when they came to India and laid out all the standards, the Indian government, Ministry of Corporate Affairs, as the case may be, said that we are okay with IFRS, it's good. We don't have no problem in implementing IFRS, apart from one particular standard. You please remove that standard and we will follow IFRS. That standard was called IAS 41 Agriculture. The Indian government's or the MCA's thinking was agriculture in India, they don't pay income tax, no GST, no VAT, nothing. Probably no books of account also. So how can they have international financial reporting standards? That was their thinking. So the IASB was obviously very disappointed. And from Delhi, I remember they were on a global tour. From Delhi, they went to Karachi. And they went and asked Pakistan, will you implement IFRS? Pakistan asked them, from where are you coming? They said, we are coming from India. Then the next question was, did India implement IFRS? Pakistan, this ISB said, no, they are having some problems with IAS 41, so they are not going to implement IFRS. Pakistan said, no, we will implement, don't worry. In 2006, without a roadmap, without any this thing, they simply went over to IFRS completely, what is called, probably the military approach to IFRS adoption. Even banks, the State Bank of Pakistan in 2006 presented their financial statements in full IFRS. But of course, subsequently, one more attempt was made in 2011, and finally now we are in the third phase of companies moving to IFRS. So what Varsha and Aina will be talking about are the significant differences, because one hour is really not sufficient time to talk about all the differences. And they have also not going to cover one standard wherein the maximum differences probably lie, which is Ind AS 109 in financial instruments. So that is also, that will take a separate session by itself. So I just thought I should give you this little bit of a brief here. Just to ensure that all of you know about it, the roadmap covers enterprises only with a net worth of up to 250 crores. There is no particular roadmap for enterprises who are below 250 crores. For them, as all of you may be aware, we are revising the present AS itself. AS 2, AS 4, AS 6, 10, 13, 14, 21, 29 have all been revised. Those revisions are almost at par with your Ind AS standard. So maybe by 2020, we probably expect that every enterprise in India which follows the accounting standard rules would come to some version of Ind AS, either the normal Ind AS or the revised AS. So it is important that all of you pay attention to all these differences which are there. There are significant differences, I can tell you that much. There are significant differences and some very subtle differences which you should probably be aware of. I'm sure that they'll take you through all of them. And just a small correction, the first speaker is going to be Varsha, and then later on, Ayana will join this. So I'm going to hand over the floor to them. Thank you.
Hello friends, good afternoon. We are here to see the key differences between AS and Ind AS. So before looking at the key differences, let's have a look at roadmap for implementation of Ind AS in India. So India has conversed with international financial reporting standards and has implemented Ind AS in 2 phases, and first of all it has implemented on a voluntary basis from financial year 15-16, thereafter in 2 phases, that is from financial year 16-17 for all companies whose net worth is more than 500 crores, holding, subsidiary, joint venture and associates of these companies. Thereafter in phase 2 from financial year 17-18 for all listed companies, other companies having net worth more than 250 crores, holding, subsidiary, joint venture and associates of these companies. Thus, Ind AS has become reality now with phase 1 and phase 2 companies have already published their financial statements as per Ind AS. Now, let's move on to our topic for discussion. So, there are enormous differences between AS and Ind AS, but today our focus only would be on these topics. So before that, first of all, let's see the differences at a macro level. Let's have a macro level analysis of differences in AS and Ind AS. Ind AS is more focused on substance over form. Say for example, goods normally sold at rupees 100 for 3 months credit period. If sold at rupees 110 for 9 months credit period, then the difference of rupees 10 is considered as interest income as per Ind AS. That is, finance element inbuilt in price is segregated and considered as interest income as per Ind AS. Further, as per AS, whenever an instrument is to be recognized, it is taken on the contractual agreement basis or whatever it sounds like. Take the example of preference shares itself. Preference shares, irrespective of its nature, is always considered as share capital as per AS. Whereas what Ind AS says, redeemable preference shares carrying fixed rate of dividend is to be considered as liability and not equity. This is because it satisfies the criteria of, it doesn't satisfy the criteria to classify as equity, because there is a contractual obligation to deliver cash or other financial instrument. We can very well compare these redeemable preference shares with the normal loans or borrowings, which is recognized as liability in the financial statements. Thus, having the nature of loans or liabilities, we classify these redeemable preference shares as liability as per Ind AS. So, we therefore conclude that Ind AS looks into the substance of the transaction and not just the form. Further, Ind AS are principle based standards and not rule based standards. To check this, let's go to the Ind AS 110 and AS 21 consolidated financial statement, where it defines the word control. Control as per AS 21 is, an entity is said to have control over another entity by directly or indirectly purchasing more than 50% of voting power or by controlling the composition of board of directors. Whereas Ind AS requires the exposure or rights over the variable return and the ability to affect those variable returns. It also requires substantive right to control the relevant activities of the investee. I know these statements are so complicated, right? So let's see the example to understand the same. There are three companies, A Limited, B Limited and C Limited. A Limited has 51% voting power in C Limited, whereas B Limited has 49% voting power in C Limited. There also exists a shareholders agreement between A Limited and B Limited, which says no activity in C Limited could be carried out without the consent of both A Limited and B Limited. So this is a scenario. Now let's check out the control as per AS and Ind AS. As per AS 21, only A Limited has control over C Limited because it satisfies the criteria of having more than 50% of voting power. Whereas Ind AS 110 says even B Limited has control over C Limited because it has a substantive right to control the relevant activity of C Limited. That is, it looks into the principle of the transaction and not just the rule that it has less than 49% of voting power. So we say that even both A Limited and B Limited has control over C Limited and not just A Limited. Therefore, we conclude that Ind AS are principle based standard and not just rule based. Now let's move into the changes in form and components of financial statement as per Ind AS. Before that, I would like you all to please recall the AS balance sheet. I know obviously you all would be knowing, but just recall so that we could be able to understand the changes in the financial statement as per Ind AS. Division 2 of Schedule 3 of Companies Act 2013 prescribes the financial statements as per Ind AS. Part 1 is balance sheet. Ind AS balance sheet starts with assets, then followed by equity and liability. So in the assets part, we can see that there is a removal of the head fixed asset. Further, a new heading has been, the tangible assets has been renamed as property, plant and equipment. Investment property has been newly introduced on the face of the balance sheet. Further, disclosure of goodwill has been separated from other intangible assets. Biological assets other than bear and plants have been shown on the face of balance sheet. There is the introduction of new heading financial assets and clubbing of some items like investments, trade receivables, loans under the new head financial assets. We also have a current tax asset, a new entry coming on the face of balance sheet. The next part, equity and liability. Shareholders fund and share capital has been renamed as equity and equity share capital. Reserves and surplus has been renamed as other equity. Further, there is a new heading coming over here is financial liability. We saw financial assets on the asset side and now financial liability in the liability side. Then clubbing of some items under the new head financial liabilities. Further, there is one new entry that is current tax liability. We saw current tax asset in the asset side and current tax liability here on the face of balance sheet. Now let's go to statement of changes in equity. The statement of changes in equity as per Ind AS is on line with IFRS with two parts, equity share capital and other equity. So let's see the statement of other equity. It has a 12 columns. And we could see that the second column is share application money pending allotment. It was there on the face of balance sheet as per AS balance sheet, whereas as per Ind AS it has been shifted to other statement of other equity. Then the column number 3 is equity component of compound financial instrument. In that the main part is the instruments include convertible preference shares and debentures. Column number 5 and 6 are debt and equity instrument through other comprehensive income. This reflects the change in fair value of the instruments which are valued through other comprehensive income. We will see what is other comprehensive income when we will see the statement of profit and loss account. The below part of this statement of changes in equity is like a appropriation account. Then part 2 of division 2 is statement of profit or loss account. The statement of profit and loss account as per Ind AS is one statement with two sections. Section 1 is profit and loss for the period and section 2 is majorly of other comprehensive income. We could see that the first section has no major changes except that the profit or loss from discontinuing operation has been renamed as profit or loss from discontinued operations. The second section is majorly covered by that other comprehensive income. What is other comprehensive income? It's basically an income, expense, gains or losses which are not yet realized to the entity. Further, the presentation of it has to be bifurcated in two parts. The items which will not be reclassified to profit or loss account and the items which will be reclassified to profit or loss account. Which will not be reclassified to profit and loss account, example revaluation surplus, and which will be reclassified to is the foreign exchange difference arising from the foreign operation. This is the example just which will come under this head. The taxes relating to these incomes or gains also will be presented in this part itself. The second major change in this part is the earnings per share. EPS has to be shown separately for continuing operation as well as discontinued operation, and we have to also present it in a club that the total EPS also has to be presented in the statement of profit or loss account. So these are the changes in form and component of the financial statement. It has improved the transparency and comparability of the financial statement, thereby giving a bulk of information to the stakeholders on the face of financial statements so that they can take the financial decision quickly. Now let's go to the differences between AS1 and Ind AS1. Disclosure of accounting policy versus presentation of financial statement. As the name itself suggests, the scope of the AS1 is narrow, whereas scope of Ind AS1 is broader as it covers the presentation of entire financial statement. there is no concept of other comprehensive income as per AS1, whereas Ind AS 1 gives us the how to deal with the other comprehensive income and gives the guidance. We just now saw how to present the other comprehensive income in the statement of profit or loss account. Then AS1 has no has a extraordinary item as a heading in the statement of profit or loss account, whereas Ind AS1 has completely striped off this topic. Then Ind AS1 says the expenses to be classified based on the nature of expenses. This is a specific restriction as per Ind AS, whereas AS1 has no specific restriction as such. Now I'll be giving you a scenario and I want some answers from you, just a yes or no type. So then I'll move on. I'll put a statement. You have to give me, is this a valid statement and it is related to the scenario. Let's take a company. What has the company has prepared its financial statement, and at the time of finalization of financial statement, the company realized that it has not considered one of the standard in its financial statement, and the effects of those standard has not been given in the figures in the financial statement. So what the management did, it has disclosed the same in its notes to account, stating that so and so standard is not considered while preparing the financial statement, and the effects of the same are not given in the figures mentioned in the financial statement. Now I want to answer from you guys whether the company is correct in its disclosure. Can the company do so? If yes, why, and if no, why? Yeah. Yeah, I will put it in a statement. The Ind AS 1 says mere disclosure is not a remedy for wrong accounting. The company cannot contend that though it has not followed the Ind AS, but it has disclosed in its financial statement that the Ind AS has not been followed. This will not rescue company from the consequences of violation of Ind AS. I want to quote one more point related to this is, even the auditors has to qualify its accounts. The auditor cannot say that a company has followed entire Ind AS except this topic, because this statement is given in Ind AS 1, then the company has violated Ind AS itself. Ind AS 1 has not been followed because disclosure is not a remedy for wrong accounting, it is given in Ind AS 1. Let's go to second Ind AS, AS 4 versus Ind AS 10, contingencies and events occurring after balance sheet date and events occurring after reporting date, Ind AS 10. AS 4 requires the disclosure of non-adjusting event in the Board of Directors report, whereas Ind AS 10 requires the same in the financial statements. Therefore, we say the new set of accounting standards are enhanced disclosure standards. It requires a lot of disclosures in the financial statements. Further, AS 4, when there is if the fundamental basic assumption of going concern is not appropriate, AS 4 says you need to adjust the assets and liabilities, whereas Ind AS 10 says the basis of accounting itself has to be changed if the fundamental basic assumption of going concern is not appropriate. AS 4 doesn't mandate to disclose the date of approval, or it doesn't AS 4 don't specify that the disclosure of date of approval in the financial statements, whereas Ind AS 10 says that we should disclose the date of approval in the financial statements. Ind AS 10 doesn't deal with contingencies. The next Ind AS or AS is AS 22 and Ind AS 12. Accounting for income taxes and income tax related standard. So, as per AS 22, the deferred tax is to be calculated based on income statement approach, whereas Ind AS 12 specifies the balance sheet approach. We will understand what is income statement approach and balance sheet approach, and then we will come back to the same slide. We will look at an example to understand the income statement approach and balance sheet approach. Let's say there is a asset. The cost of the asset is 1 lakh rupees as per accounting records and 1 lakh rupees as per tax record. Depreciation is 10,000 as per accounting records and 20,000 as per tax records. Thereby, written down value is 90,000 and 80,000 respectively, accounting records and tax records. So now let's see what is income statement approach. The income statement approach takes the difference of the depreciation, that is 20,000 minus 10,000. Let's take 30% is the tax rate, or the 30% is applied on the difference of 10,000, and we calculate 3,000 of deferred tax liability. Whereas balance sheet approach takes the difference of WDV. We call in Ind AS the carrying amount, the difference of carrying amount and tax base. That is 90,000 minus 80,000. 30% is the tax rate, we will apply on the difference of 10,000, 30%, the ultimate answer is 3,000. So looking at this example, we conclude that there is no difference between income statement approach and balance sheet approach, right? Right? No difference between income statement approach and balance sheet approach. Yes or no? No. How can yes? See, there is a difference between yeah, there is a difference. Maybe the ultimate answer is tax neutral, but the way of getting answer is different in both the approach. Because in income statement approach, we just consider the difference of depreciation. Here I can again prove that the Ind AS are principle based standard and not just rule based standard, because the balance sheet approach says the difference in WDV. Why does it take the WDV difference, that is carrying amount and tax base? It explains like that, as we are getting rupees 90,000 of benefit in the remaining period of the asset, that is 10,000 rupees of extra benefit. On that extra benefit, we are liable to pay extra tax of 3,000 rupees. Thus, we recognize a liability of tax of rupees 3,000, and this is the logic behind the balance sheet approach. Whereas, there is no logic behind the income statement approach. We just take a difference of depreciation. So, let's go back to the same slide to understand the other differences. AS 22, while calculating the deferred tax asset, it applies the prudence rigorously. It has a rigorous application of prudence, because it says you are allowed to recognize deferred tax asset only when there is a reasonable or virtual certainty supported by some convincing evidence. It is very stringent on the matter that you are not allowed to recognize a deferred tax asset unless you have any rigor or reasonable or virtual certainty of the income in future. Whereas, Ind AS 12 is quite lenient on that, and it says even if the company is probable, they can recognize a deferred tax asset. Further, changing tax status situation is not dealt in AS 22, whereas Ind AS has a guidance on how to deal with changing tax status situation. There is a guidance in AS 22 where to deal with the tax holiday situation and the situation where 115 JB of Income Tax Act applies, that is MAT provision apply. Whereas such guidance we don't find in Ind AS 12. Why so? Because these situations are country specific. Whereas Ind AS is a global standard, adoption of the global standard, and it doesn't contain any country specific situations. These are the differences between some Ind AS, and we also had some macro level analysis of differences. We also looked at the changes in form and components of financial statements because of the implementation of Ind AS. The other differences would be dealt by my co-speaker Mr. Ayana. Before listening to him, it's an interesting Ind AS he will be going to deal with. But before that, let's have a brief about the impact analysis of implementation of Ind AS in India. International Financial Reporting Standards is viewed as a global standards. More than 100 countries have already conversed or implemented Ind AS in its countries. Its implementation in India has improved the comparability and benchmarking of Indian companies' financial statements with the global peers, thereby improving the accessibility of Indian companies to the global capital market. India is still a baby stage, and we as a future chartered accountant have a great ahead to deal with its complexities in its young age. Thank you for giving me an opportunity to speak on this topic. Over to my co-speaker, Mr. Ayana.
Thank you, Varsha. There was a famous saying, progress without change is impossible. Change makes us grow. Why am I saying this? Come on, why am I saying this? Excellencies, distinguished delegates, and my dear budding chartered accountants, a very good afternoon to one and all present here. Today I am standing before you to present on the massive change which has happened in 2015. Differences between Ind AS has come into picture. So I'll be presenting you the key differences between accounting standards and Indian accounting standards. Okay, before beginning the session, let me ask you one question. Why are we conducting this session? What's in it for us? So there are two major reasons for knowing these differences between accounting standards and Indian accounting standards. Let me tell you the first reason, which is it covers more than 70% of our final CA FR syllabus. And the second reason is being a future chartered accountants. We will be the future chartered accountants, and we have to help a lot of corporates in implementing the Indian accounting standards. So since my co-speaker Varsha had dealt with the implementation and roadmap to Ind AS, now I will be dealing with the key differences between Ind AS and accounting standards. So this is the agenda for today's discussion. We'll just on a note, overall basis, we'll discuss on the implementation of Ind AS. We'll see the bird's eye view of the difference between AS and Indian accounting standards, and we'll be dealing with few more differences between AS and Ind AS. So the bird's eye view, to sum up the massive change, the bird's eye view of the difference between AS and Ind AS is, Ind AS has two components now, which are changes to the existing accounting standards, and there are completely new accounting standards, which are Ind AS 29. There is a separate standard on hyperinflationary economies, which was not there in accounting standards, and there is a separate Indian accounting standard on investment property, which some portion of it was there in AS 13 investments. For agriculture, we have a separate standard, Ind AS 41. And 101 it's an important standard because it will help the companies for adoption of Ind AS. Share-based payments, we used to have a guidance not on share-based payments, but there is a altogether separate standard on share-based payments. Insurance contracts, exploration and evaluation of mineral resources, there is a separate standard on it. And like Mohan sir mentioned, this is the major change, a biggest Indian accounting standard, financial instrument and fair value instrument. So today we will be dealing with the changes to the existing accounting standards. So we'll begin with first change, which is AS 5, net profit or loss for the period prior period items and changes in accounting policies. The same has been changed to Ind AS 8 and renamed to accounting policies, changes in accounting estimates and errors. So, the first and key difference between AS 5 and Ind AS 8 is presentation of an additional balance sheet at the beginning of preceding year. In IGAP, have we ever presented an additional balance sheet? We used to give a comparative periods. Have we ever presented a balance sheet on the beginning of the preceding year? Come on, people. Have we ever presented? But Ind AS requires us to present an additional balance sheet if the company has changed its accounting policy in the current year, if the company has reclassified some captions in the current financial year, or if the company has prior period items in the current year. So, and there is one more difference, like we spoke, the prior period errors. If we have any prior period errors in the current period, the company has to go back to that year, change the numbers and present the additional balance sheet with restating, with changing those numbers retrospectively if the prior period errors are material. So we'll have an example on this. The company was following FIFO method for valuation of inventory. Now the company has changed the valuation of inventory method from FIFO to LIFO. Is this a change in accounting policy? Come on, answer. Absolutely correct. This is a change in accounting policy. The company has to restate the previous year's numbers and present an additional balance sheet giving effect to the LIFO method of inventory valuation. One more example. The company was following SLM method of depreciation and changed to WDV in the current year. Is it a change in accounting policy? Come on. Why is it not a change in accounting policy? Come on. Exactly. This is a change in estimate. This is the biggest difference in Ind AS and accounting standards. In accounting standards, depreciation was an accounting policy, but in Indian accounting standards, depreciation is an accounting estimate. So this is not a change in accounting policy. And in IGAP financials, we used to see one line, prior period errors and extraordinary items. What are those extraordinary items? Example? Examples like insurance claims, sale on profit of a business unit, those are the extraordinary items, right? In Ind AS, we don't have such concepts. The company cannot show any income or expense as extraordinary items. So let's move to the next accounting standard, which is Ind AS 17 and AS 19. AS 19 has been renamed to Ind AS 17 and its name is still same, but the standard number has been changed to 17. So the key difference in this accounting standard is exclusion of land leases. Land was never part of accounting standard. Land we used to always show in balance sheet. It was not subject to assessment. But under Indian accounting standard, we have to assess for the land. If the land is pertaining to finance lease, then only we can show it in the balance sheet. If it is not pertaining to if it is pertaining to operating lease, then we should not show the land. Think logically, finance lease, at the end of finance lease, the risk and rewards, the still lesser and lessee becomes the owner of the property. So there is it makes sense to show the land in the balance sheet. But operating lease, after the expiry of lease term, there is no connection between lessor and lessee. You are not supposed to show the land. And one more key difference is straight lining. All that complicated calculations what we used to do, straight line rent equalization reserve, unbilled revenue, that is not there now. So Ind AS specifically, Ind AS 17 specifically says if the escalation percentage is in line with the general inflation, the company need not do straight lining. Think about the impact of this change, people. When the company, suppose say rent for the first year is 10 rupees, second year 11 rupees, third year 12 rupees. The company used to allocate equally over the 3 years. But now if 10% is a normal general inflation, so the company used to show a notional, it's not notional, but used to recognize the rent which it going to receive or which is going to pay in the subsequent year, in the current year under accounting standard. But now if it is in line with inflation, the company cannot do that. The company has to show the actual rent paid or rent received. Because by doing this under accounting standard, the company used to violate conservatism principle. Suppose a leasing company will have a crores of rentals every year. The escalation percentage will be 10%, which is normal. So the company used to show additional, which is going subsequently what the rent will be receiving by the company, that will be there in the revenue from operations. So that is a violation of conservatism principle, which Ind AS doesn't allow company to show that if the escalation percentage is in line with inflation, the company cannot do straight lining. Lease in substance. This is also one of the key change, which is no guidance on arrangements that do not take legal form of a lease. Arrangements, Ind AS says, arrangements that do not take legal form of a lease, but fulfillment of which dependent on the use of specific assets and which convey the right to use the assets are accounted for lease. What is it? I didn't understand. Have you understood? Let's see an example for this. Mr. A, he is an automobile manufacturer. Mr. B, he is a job worker. And the details are given below. Mr. B manufactures components of machines upon the specifications of Mr. A. Mr. A controls Mr. B. Mr. B uses assets including premises of Mr. A to produce the machinery components. Mr. A pays per machine piece job work charges to Mr. B. And Mr. B provides job work services only to Mr. A. What is the treatment of the transaction? Any answer? You want to see the question again? Mr. B manufactures specific components for Mr. A. Mr. B is controlled by Mr. A. Mr. B uses assets including the premises of Mr. A. Mr. A pays per machine job work charges to Mr. B, and Mr. B provides job work services only to Mr. A. What is the accounting treatment? What is the treatment of this transaction? Any answer? Come on guys, any answer? No answers. Come on. I heard some answer. What? No. The answer for this is Mr. A becomes the lessor, Mr. B becomes lessee, and the transaction should be accounted as per Ind AS 17. So that is the biggest change. In accounting standards, we used to treat this as subcontracting. So the expenses incurred by Mr. A will be treated as subcontractor charges. But Indian Accounting Standard 17 says the transaction is a lease transaction, should be accounted as per Ind AS 17. So now let's read that and we can understand the same. No guidance on arrangements that do not take legal form of a lease. Legal form of a lease. This takes the legal form of a lease. So Ind AS 17 says arrangements that do not take legal form of a lease but fulfillment of which is dependent on use of specific assets and which convey the right to use assets are accounted for as leases. So in this case, Mr. A has control over Mr. B. Mr. B is providing services only to Mr. A. and he gets monthly job work charges. So this transaction should be accounted as per Ind AS 17. And one more difference between Accounting Standard 19 and Indian Accounting Standard 17 is indirect cost, initial direct cost of lessors for assets under finance lease or operating lease. What was the treatment of in AS 19? Suppose say initial direct cost incurred by lessor, suppose say brokerage expenses incurred by lessor. What we used to do under Accounting Standard? What is the treatment of that? We had two options. We had two options of, one option is recognize immediately in the profit and loss account. Second one was allocate it over the lease term. But Indian Accounting Standard says we have to assess that charges are pertaining to which lease. If it is pertaining to finance lease, it is included as a part of interest rate implicit in the lease. So finance lease we will be accounting as an interest expense. We will be calculating the percentage. You know IRR, right? Internal rate of return. So we'll be calculating that percentage, and these charges are considered in calculating that IRR percentage. And if it is pertaining to operating lease, the expenses, the initial direct costs which the lessor has incurred are to be added to the carrying value of the leased asset, and that will be amortized over the period as depreciation. So the next accounting standard and Ind AS will be dealing is AS 12, accounting for government grants, versus Ind AS 20, accounting for government grants and disclosure of government assistance. Can anyone tell one difference by looking at the name? What is the difference, key difference? Disclosure of government assistance, exactly. The name itself says AS 12 was only accounting for government grants, but Ind AS requires the companies to disclose the government assistance received. So, government assistance, examples are like MEIS, Merchandise Export Incentive from India scheme. So the merchandise income, whatever we get when we export, that is a government assistance. So that we have to disclose in the financial statement. It's not a government grant, but that we have to disclose in the financial statement. In IGAAP, we never used to disclose government assistance. That is the key difference. And scope. One more difference is waivers from government are not considered as government grants in accounting standards. But Indian Accounting Standard 20 says waivers from the government qualify as government grants and to be accounted as per Ind AS 20. It's substance over form. We have to see the substance over form. If the waivers, suppose say, I'll give an example, interest-free loans, that concession loans, what government gives. So that concession is to be qualified as government grants, and it should be accounted as government grant. So the next difference is measurement of non-monetary assets. Suppose a non-monetary assets like land. Farmers get land, right? Farmers get free lands, right? So if that land is for free, accounting standard used to say record it at nominal value, like 100 rupees, 1 rupees, 10 rupee, nominal value. But Ind AS 20 says it should be accounted at fair value. Imagine if farmers had to prepare books of accounts. What is the amount? What is the biggest change? From 10 rupees, 100 rupees of accounting land to fair value. And if the company is, if the consideration is at concessional price, the actual price is to be recorded under accounting standard. But now under Ind AS, we have to record it at fair value. And recognition in natures of promoters' contribution. So under accounting standard, we used to credit that government grant, whatever we received, if it is in the nature of promoters' contribution, directly to the shareholders' fund. But Ind AS prohibits of recognizing a reserve. Ind AS says create a deferred income and allocate it over the years. Concessional rate loans, this we have already discussed. AS 12 doesn't have any guidance on the treatment of such loans, but this concession should be accounted as per Ind AS 109. The recognition criteria for various assets in AS 12, we had 3 options. We can set up a deferred income, or we can reduce the grant from the asset carrying value of the asset, or if it is related to non-depreciable asset, we used to show the grant as capital reserve. But Ind AS prohibits from showing as a reserve. Ind AS only requires setting up it as a deferred income and allocate it over the coming years. Borrowing cost. The next Ind AS and AS difference what we will be discussing is borrowing cost. So borrowing cost scope exclusions. Ind AS 16 never had a scope exclusion, but Ind AS 23 have some scope exclusions, which are, if the qualifying asset you are recognizing it at fair value, you need not apply Ind AS 23. Because under AS, what we used to do is, we used to add the borrowing cost to the book value of the asset. But when you are recognizing the asset at fair value, that borrowing cost portion will already be considered in the fair value. So you need not account separately for the cost. And inventories that are manufactured or produced in large quantities. So if it is unallocable, the cost, if you are not able to allocate, you can recognize that in the inventories. And next difference is interest calculation. So interest calculation, we used to record the actual interest paid in the P&L, but now it suggests us to account the interest as per EIR method. You know IRR, right? IRR calculation. It is calculated as per discounted cash flow method, and we have to account the interest paid using EIR method. And foreign exchange differences on long-term foreign currency borrowings. Suppose, say, you have a real estate company has borrowed 100 crores of loan, foreign currency loan, before Ind AS transition. The difference, forex difference between that loan, under accounting standard, it used to be considered as borrowing cost. But Indian accounting standard prohibits, from the first year of Ind AS implementation, the foreign exchange difference on long-term foreign currency borrowings to be charged entirely to the profit and loss account. So the next and final standard what we will be dealing is segment reporting. AS 17, we used to determine the segments using risk and rewards approach. So the risk and rewards approach are company specific. What the risk company has and what are the rewards it's going to be get in the future. Based on that, we used to determine the segments. But Ind AS 108 says to be determined by the CODM, Chief Operating Decision Maker, has to determine the segments of the company and disclose. And there is a mandatory requirement of disclosing the segments, which is AS 17 never told us to mandatorily disclose the segments. It says if entity has to, if segment reporting is applicable for the entity, then entity has to classify the segments as primary or secondary segments. But Ind AS 108 says even if the segment reporting is not applicable to the company has to disclose the segments based on external revenue from each product or revenue from customers and geographical information on non-current assets. So by this we come to the conclusion slide, which is Ind AS and accounting standards and Ind AS. The impact is very huge. So we have to assess, we future chartered accountants of India, we have to assess the impact of Ind AS and help corporates in implementing the Indian accounting standards. Thank you.
Good man, good show. Okay, I understand that a little bit of impatience is going on because people are clapping, and all of you want to break for a cup of tea, I think so. No, but don't worry, tea will come in some time, right? It's not immediately. Now, I just want to sort of, first of all, congratulate both Varsha and Ayana for an absolutely brilliant presentation. See, the problem is that I think they've been working for the last how many days now? 10 days on this? Yeah, 10, 15 days on this presentation. There are 39 applicable Ind-AS standards with an average of 2 differences per standard. That makes it 78 differences. So to capture about 10 standards in about 20 minutes, as both of them have spoken about, I think is really a tremendous effort. So congratulations, both Varsha and Ayana. Actually, good effort, right? Now, for all of you in the audience, now that you know a little bit of the difference between AS and Ind-AS, I'm assuming that you know whatever standards they spoke about. And I also spoke a little bit about Ind-AS 109 being the main standard, which is, will have a lot of difference. You can do this exercise in your office. I mean, if you just go take out any client's trial balance, and in that particular trial balance, you start applying the applicable Ind-AS, you will find that only one standard stands out as a majority. It will be Ind-AS 109 financial instruments. Because deposits, loans and advances, loans, trade receivable, trade payable, everything is covered under Ind-AS 109. That standard will stand out. You will also apply, whatever they are speaking about, those standards probably to specific transactions, like government grants, you will probably have one standard. Leases, you'll probably have one standard applicable. But the standout standard will definitely be, 109. So maybe some other time you should probably look at 109 as a separate difference, because that's a channel which will obviously have a lot of impact. Now, the best thing about Ind-AS is that once you finish this particular conference and you've taken the presentation from both Varsha and Ayana, you will feel that I know a little bit about Ind-AS. Unfortunately, that's not true, because the standards are changing. He just spoke to you about Ind-AS 17. Ind-AS 17 is now going to change to Ind-AS 116, which is probably going to come as early as 1/4/2019, in which the entire concept of leasing has been turned on its head. They are talking about the lessee showing any lease beyond 1 year as a right to use asset. So these standards are changing. Maybe probably in a couple of years' time, we may have some sort of a stability in terms of, we would have probably had only amendments, or we will have probably minor amendments to each of these standards. But it is a really interesting period for anybody who are doing your articles or who are studying to understand, because the International Accounting Standards Board, even today, feels that India is not IFRS compliant, because we are having a small carve-out here and there. They still feel that India is not IFRS compliant. They are saying you will probably have to, sort of tone down your carve-outs. We have already removed some carve-outs. For example, Ind-AS 40 investment property was not allowing us to do a fair valuation. That has been amended now to do a fair valuation. So I would probably assume that in a couple of years' time, we will probably, be about 80 or 90% on par with the global accounting standards. And as all of you know, the reason, because why are we talking so much about IFRS and Ind-AS today is because it appears that there's a global movement to move towards one single set of accounting standards, and probably the biggest decision which US GAAP did was to permit non-US filers to present their financial statements in IFRS. I think that was probably one of the biggest benefits which the US GAAP has done. Therefore, US GAAP will only be applicable to US GAAP companies now, or companies incorporated in the US. The rest of the world will probably move over to IFRS. So in India, as we have seen, are probably about 70-80% there. We'll probably go in a couple of years back to 90%, or probably even 100% if things go well, right? So this is what I wanted to say. So I should thank Shravan and Srinivasa for giving me an opportunity to come here, chair this session. If there are any doubts on this session, please ask them, not me. Okay, thank you very much. Thank you.
I thank session chairman for chairing this session, and also thank him for his time and effort for sharing his knowledge with us. I thank on behalf of Bangalore branch of ICAI and Sikasa Bangalore our session chairman CA Mohan R Sir, and student speaker Ayana Chari and Varsha Jain. May I request Varshita to present memento as a token of gratitude and respect to CA Mohan R Sir. I request Varshita to present memento to the student speakers Ayana Achari and Varsha Jain as a token of appreciation. Thank you. This concludes the technical session on differences between IND AS and AS. Thank you. Over to Vedant.